We're gonna go live on this. Beautiful.
Perfect. I'm excited.
Awesome. I'm here with Cora Matzek on the full Monty from New View Trust Company.
Hi.
And it's great to have you, Cora. Thank you for coming on.
Thank you so much for having me. I'm really excited to join.
Awesome. Awesome. Cora, so I know you from one of my real estate investment groups, and we've chatted briefly several times about what you do for our clients, but I wanted to get you on because I wanted to know more about this 401k investing program and how that actually can benefit, our clients. Uh, so introduce yourself to everybody and let us know
Yeah.
what you do.
Yeah. So my name is Cora Matzek. I am the business development manager with New View Trust Company. And if you're not familiar with New View Trust Company, we are a premier custodian. So what that means is you can utilize your IRA funds, move them over to New View, and invest in alternative assets. So this could be purchasing real estate, private lending, purchasing notes, tax deeds, liens. The lists are endless. So that's what we do. Really, our mission is to assist people in retiring better. And what better way to purchase real estate in a tax advantage way?
Right, right. So you said alternative assets, not just real estate. So, for example, I met somebody that deals in real estate backed notes, right?
Hmm.
They buy mortgages, right?
Yeah,
Could I buy mortgages with my 401k now?
you could. You could. So, the way that I like to describe it to people is if you have your IRA or 401k already with a custodian, so Fidelity, Charles Schwab, we're essentially all the same thing. What's different about each custodian is the menu that they offer. So, for example, you self-directed is just a marketing term. Really, self-directed is just being able to self-direct your funds within the menu that your custodian allows you. So the common knowledge is stocks, bonds, mutual funds, things of that nature. So when I tell people, hey, you actually can purchase real estate or notes, it's such a different concept for people to grasp. But I try to ease that intimidation with by saying, you already actually are doing this. What's different is your custodian doesn't allow you to purchase alternative assets. We do. So that's really the main difference.
Got it. Got it. So with Charles Schwab, for example, because their business is stocks and bonds, right? That's the product that they're placing your 401k in.
Correct.
You guys have a wider perspective of how to use your 401k tax deferred money. So
Yes.
first of all, let's tell people what a 401k is because we're assuming that everybody has a 401k or knows what a 401k is. But let's back up one step. A 401k is an investment account, correct?
Yes, so a 401k it will be funded from your employer. Now, you can also have an IRA account, so individual retirement account, something that you have set up on your own. So we see this a lot with entrepreneurs, realtors, um, people who are in those professions. They have the IRA account because it's not coming from their employer. Or you might have had a 401k from a previous employer, and now you can change that into an IRA. 401k is just employer funded. That's really the best way to think about it from that aspect. Um, and essentially, you can have your IRA or 401k with any custodian that you want. Changing custodians is not a taxable event. So
Okay.
another
So let me
misconception
let me
there.
let me pause you here because that's actually something I have a question about because if I worked for whatever company, right?
Hmm.
Big company, Fortune 500 company, they have a 401k matching program, right?
Yes.
And I say, okay, I want to max out my 401k. And they say, okay, here we deal with Schwab. Can I say, okay, I don't want to deal with Schwab. I want to work with New View Trust instead and put my matching into New View Trust instead.
Potentially. So we always tell clients or potential clients, it is up to that custodian or your funding. So what we say is reach out to whoever is your custodian and see what those options are, because it's not necessarily a no or a yes. It's different based off of employer, based off the agreements with that employer and that custodian. But there is a possibility where you can have part of it with whatever custodian your employer chooses, and you can have a portion wherever else you would choose. So I always recommend reaching out to that custodian, not necessarily the HR department. It's always worth a shot, but more extensively, the custodian is going to know those specifics. So reach out to whoever your current custodian is with that employer.
To see if I have the option to.
Yes, because it is. We have seen it before. We have seen it, but I don't think it's commonly known that that's possible.
Okay. So then the other option I have, if I have a 401k and I'm getting contribution matches, I don't want to maybe add anything extra to that 401k. I want to start my own retirement account, tax deferred retirement account. What's my option there?
So it really depends on what your profession is and what your strategy is. So what we always say is go get the advice from the people who know your financial situation the best. Your CPA is going to give you the best strategy. There's so many different strategies that I don't think people are aware of, and that's where the complexity is. Changing custodians is not that's the easiest part of it. What is your game plan? What is your end goal? What are you wanting to do? And that would be who you would wanting to speak to. You'd want to relay that information over to your CPA. But if you're so for an example would be if you're self-employed and don't have any employees, W-2 employees, you would then qualify for what is called a solo 401k, which I like to look at the solos as take your simple IRA, so traditional Roth, and think of the solo as the key to get you to that next level to be able to do max contributions, so up to 66,000 or 25% of your income annually. You can borrow against it if you need to, up to $50,000, and then you create a loan to pay yourself back. So in all essence, strategy and knowing where you want to go is going to be how you can map out what you're wanting to do, because there is truly so much strategy with this.
Okay, but you do provide several different investment type accounts that
Correct.
can fit most people. So I'm a self-employed real estate agent, right?
Yes.
And I receive I'm an S corp in my business. I could have a 401k that my business matches up to the maximum legal limit,
Correct.
$66,000.
Yes, if you have the solos.
The
Now, if you
solo.
just have your traditional Roth, annually those amounts change, but that could be anywhere. So this year, 6,000, 6,500. So if you're looking to get somewhere quick, which we do find people who are just maybe starting, and if we always ask them, hey, do you meet these two qualifying factors? Because you could be putting in a lot more, and there's more benefits. But just to simplify it,
So
it
what's
just
the
shows you.
difference between a Roth and a self-funded 401k? What's
So self-directed or
so
solo?
the
Solo.
solo, the solo.
So the best way I like to describe it is you have your traditional, your Roth. Your traditional, you pay your taxes later. Your Roth, you pay your taxes when you're contributing those funds. Now your solo is still going to be a traditional Roth. It's just that extra layer to be able to allow you to do max contributions, borrow against it, things of that nature. So it's still, just think of it as a plan adoption. You still have your Roth or traditional, but you could do a little bit more because you meet these qualifying factors.
Okay, and let's clarify the quantities again. I could put in how much on a traditional IRA
6,500.
and how much for a solo 401k.
Up to 66,000 or 25% of your income if you meet the two qualifying factors. So
Yeah.
self-employed and no W-2 employees.
Okay, so I have a feeling I know who lobbied for that law. Okay, I really do have a feeling of who got that law through the deal, the
It's
deal.
a significant difference for sure.
10 times 10 times the savings. But see, this is the importance of having a conversation with somebody like you, because it really brings things into light. Who cannot, I mean, you could benefit so much from putting in that much money if you're trying to maximize your savings, your
Yeah,
tax savings
well,
a year.
I have a lot of people who there's a common misconception of them believing that their belief is I don't really have that much to start with, or maybe I have so much, but then they just have that traditional or Roth, and then we find out with more questions like, hey, you actually could qualify for a solo or things of that nature, but you don't necessarily need thousands and thousands of dollars to start investing in alternative assets.
Yeah, absolutely, absolutely. So let's look into what we could do with 401k funds to help you grow your your portfolio a little bit better, right? So the magic happens because you're either tax deferred or tax exempt, right? So
Yeah, because you've
you either
already
pay.
purchased those, you've already paid the taxes. So an example would be, let's just take purchasing real estate as an example. And let's just say I have $10,000 into my Roth account. And remember, with Roth, I've already paid on my contribution of that 10,000. I've already paid the taxes on that. And I find this property. Let's just say the property is $2,000. And I purchased the property, fixed it up a little bit. I put another 1,000. I'm 3,000 in. And I have renters. And eventually, let's say 20 years down the road or whenever, I decide that I want to sell this property and it magically turns into $500,000 and I sell it. It actually never left my IRA, but that money comes back and you've already paid taxes on the contribution because it's the gain on that is not considered a contribution. So you're not paying taxes on that $500,000 that you've just received back. At
Okay,
that point, when it comes down time for you to take out your required minimum distributions, then it's just income tax at that point.
okay.
But we're looking at a significant difference of selling a property in a tax advantage way versus selling property in a non-tax advantage way. I mean, it just kind of shows you truly can be robbed of a good retirement if you're not doing these things in a tax advantage way.
So one reason I would imagine to do this would be, in your example, I purchased this property. I used my Roth IRA, right, or my retirement plan to purchase this property with money that I've already paid taxes on or tax deferred. Doesn't really matter, right?
Correct.
But now I have a vehicle that I can put all of my proceeds in from the sale into it, tax deferred again, right? So rather than April 15th paying uh, 30% or ordinary income on the sale of this transaction, I am now putting that money that would have gone to the IRS back into my retirement account. And it allows me to use that as additional leverage, additional financing, funding to myself, a loan to myself,
Yeah, if you
you
have a
know,
solo, for
a-
sure.
anything like that. So now it allows me to use more leverage on a bigger amount.
That's correct. Yeah. So, and I always tell people, it's exactly how you just described it. And if you do just have your traditional Roth, you would not be able to personally borrow that money. Maybe you found a property or you need to do some fix up in your own personal home. You could take that money as a loan with a solo up to $50,000 and utilize those funds where you necessarily wouldn't have been able to do that in just a standard traditional or Roth. Um, but exactly that is it is a tax advantage way to growing your retirement account. And your IRA isn't meant to benefit you while it's an IRA, but there's definitely strategies where you can get assistance, right?
Right.
Like the solo 401k loan. And there are other ways. If you're fully funding a property with your IRA, everything still stays within that account. That's how it can remain tax-free or tax deferred, right? Um, but there are other strategies as well too, where you can actually partner up with your IRA. So let's just take 50-50. You went in 50-50 on a deal, because you are looking for some passive income and you're not wanting to wait until you reach retirement age to start pulling out those funds. You can go into business with your IRA or other people's IRAs. But let's just utilize ourselves as example. So 50-50 with your IRA, 50% of that profit would go to you. Of course, you're taxed on that point. 50% would go back into your IRA, just however you guys had that distributed. So there's other strategies as well too.
So
It's
you don't have to leave all of it in your IRA. You could partner up with your IRA as a separate entity that's your partner. And
correct.
then this way you have a set distribution of the proceeds that you're leaving. And it doesn't have to be 50-50, right? Just to
Right. It
be
could be
clear,
whatever you
you could
you
you could
choose.
say, I'm going to leave 30% in this IRA every single time, 50%, 100%, whatever percent you want, that just take just enough to refund the transaction, however it is you want. You can structure this to benefit you the most. And the most beautiful thing is that that interest keeps compounding on all that deferment. So instead of paying the IRS those chunks of 15, 20%, whatever your taxable income is, you're leaving that in the account, and now you're making the interest, the compounding interest on the money that you would have sent to the IRS.
Yeah, you're essentially, I mean, it's a tax strategy. Um, and you could have a little bit of best of both worlds. You can be growing your retirement account in a tax advantage way. You could be also taking some funds for yourself as well too. And yes, to answer your question, it could be however you want to split the percentages. I use 50-50 just as a quick example, but it truly, the thing to keep in mind is whatever you go into business with your IRA, for example, if it is 50-50, it needs to be 50-50 down the line. Repairs, things of that nature, 50-50 all the way.
Right, right. So you can't just change the deal as you need it. It has to be
Correct.
it has to be set from the
Yes.
beginning. But
Yes.
you could have different arrangements for different projects, though, right?
Of course, of course. And another thing that I like to tell people too is make sure if you are going to be back to the property example, if you are purchasing a property, make sure your IRA, if you're wanting to fully purchase it with your IRA, make sure you have the funds to be able to pay for those repairs that might arise. Your IRA has to fully fund it. If you don't believe that you're going to be able to have all of the funds for that, then you're going to want to look into partnering up with yourself or another IRA at that point so that they can assist on taking those repairs. So that's something also to consider as well too. Make sure
Okay.
you can fully fund your repairs because you cannot go in and put your own sweat equity in. The IRS essentially saying you're already getting a tax advantage by purchasing these assets with your IRA.
Right.
Um, you can't dip into you can't double dip.
Right. So leaving your labor inside as well.
Right, because then you essentially could charge yourself what I mean, you can charge yourself whatever, or you can create things that would just create um, red flags for the IRS.
Okay.
Yeah.
So, Cora, now where does New View as an intermediary fall in? Like, what's the service that you guys can provide, and like guide me through a transaction with you guys.
Yeah, so as I mentioned, we're a custodian. So what a custodian essentially is we're just holding your funds. We do not provide any tax advice, legal advice. Now, we have education. We provide education to our clients as different strategies and bring in experts to speak on those strategies. But we always suggest going back to the people who know your unique situation the best. You're your own CPA, your own attorney. But essentially, what this consists of, you hear about New View, you hear about the things that you could do. What does that look like? It's a matter of calling us up. We can figure out what you're wanting to invest in because we do have different divisions. So I'm more on the retail side. So that would be your single family homes, your notes, your tax deeds. These are examples, private lending. We do have, if you have an advisor, we have an advisory team that your advisor could work with. essentially take care of all of your needs through that advisor. We also have a syndication team. So syndications, if you're not familiar with syndications, these are going to be people who are raising capital for much, much larger projects. So within the millions and millions of dollars. And you're working with a sponsor or syndicator at that point. But essentially, it's the same theme with whatever division you're in. You call us on the phone or reach out to us via email. We figure out what you're wanting to invest in. We would then send you over a DocuSign application. This is your basic information about who you are. And we would transfer your funds from your contra custodian, your current custodian that you're with now, via transfer form, which is IRA account to IRA account, or a rollover form, which is a 401k account to an IRA account. So those are the two differentiating factors. You might get a transfer form, which means you already have an IRA account established.
Okay.
You might get a rollover form where we're actually changing your 401k, your employer funded account, to an individual retirement account. So
Okay.
those are the main differences. Again, it's not a taxable event. It's just the way to classify the accounts at that point.
Okay.
And it's as simple as that. Our team then opens your account, gets it funded. The turnaround time is anywhere between 5 to 7 days. If you're thinking about doing it, what I found is a lot of these deals are time urgent.
Yeah.
If you have a property already in mind and you need to get things done within 3 days, you are going to be under a lot of pressure because
So this is something that you might want to plan out,
you do
not
want to
not
plan this
have to
out.
fit out. So
Yes.
I'm glad that you touched on that. So let's say that I have my account already set up. I've called you. I don't have a retirement account. I want to set up a solo 401k. I call you, Cora. I said, let's set this thing up. Let's rock and roll. Here's my $66,000 for my first tax deferred event, and let's go shopping. Right? I now have an account with NewView, and it's a ordinary Tuesday afternoon, and I found the house, and I put a contract in on the house. I bought it under one of my holding corporations, or I put it under contract under one of my holding corporations. I call you up, Cora, say, I found the perfect deal that I know what I want to do with my money. What do I do now?
So if you have the Roth or traditional, you tell us where to point and we shoot. We send the funds to where you need it to go. 24 to 48-hour turnaround time for that, unless you could do wires. Now, here's the next thing, to add a layer of capabilities with these solos, right? If you have a solo, you do automatically qualify for what is called checkbook control. This means that you could go create a bank account at any bank of your choice and have your funds moved. So your IRA funds moved to that bank. And essentially you have direct access to those funds. And then it's a matter of writing a check or swiping a card at that point. It's a quicker turnaround time if that's something that you're wanting or needing, quick turnaround times. We usually find that with people who are purchasing notes, things like that. They need quick turnaround time.
Okay. And what about the accounting for all of this? I could only put money in there, and I could only use it money to invest in the projects that I'm using. So I don't want to be writing checks out of it for Publix, right? Like that's
Right,
not.
right.
So there's a little bit of greatness to the freedom of it, but
Yeah.
I could see where it could probably lend itself to some abuse. What's the deal with accountability on this?
Yeah, so in that case, we do offer a record keeping option as well too. So we can record keep for you. It is one of those things with, do you want to mow your grass or do you want someone else to mow your grass for you?
Okay.
So it there with great power, there's great responsibility. So
I knew that
we always you knew that was coming,
I
but
knew
yes,
that was coming.
that's exactly what it is. We tell people all the time, hey, the speed limit's there. But it's up to you if you want to go that speed limit.
Right.
We're not the police. We're not. We just do what you tell us to do. And it's truly up to you um, to to uh, to do the right thing.
But the magic of staying in trouble is keeping clean books and knowing that you're not going to be, uh, violating any of these laws or commingling laws. But just to be clear, you guys do keep us on the straight and narrow, making sure that we're filing the proper forms, or we're getting
Yes, of
our
course,
transaction reports.
we can offer record keeping with your account. You'll get your annual tax forms that you'll need for your CPA to file your taxes correctly and accurately. So we for sure are able to provide the correct information. Um, that those are going to be important for you.
Okay, and that's only the solo 401ks that have that kind of autonomy, because it's the person that's more of a professional
You see a
level.
lot of business owners or people who are already doing it to some
Yeah,
extent.
yeah.
And we do have people who maybe want to try to get into it. You know, we say all the time we could record keep because we could record keep for just the Roth or traditionals if you like. And then until they start to get a little bit more comfortable, then
I
they take the record keeping
I
off.
have a couple agents in mind, and if you're watching this, you know who you are, and I could just see your regular bank account getting low. You're out on a Saturday night, and just I could
Oh
see
goodness. Oh goodness.
the temptation already there. That's why, so
It's
leave the
definitely
checkbook at home if you have a 401k solo.
yes, yes, for sure, for sure.
No, but
It's
yeah, I
great.
mean, I think that that's probably what we're going to be having a conversation about, is starting a 401k. What about the like New View? Obviously has a servicing package and everything else, depending on what level of account you're going to get, if you're going to get the bookkeeping, things like that, right?
Right, right. So, as far as you're inquiring about different fee schedules,
Right. Everything's
yeah,
changes usually, but is it based on a percentage of that you have in there? Is it, a
no,
monthly?
not at all. So what we like to do is we like to say that our fee schedule is very transparent and easy to understand. And we don't charge percentage. Here's something to consider. If you charge percentage, the more your account grows, you're essentially having to pay more money. So it's there's a lot of math behind it, but also it's like, well, I'm being successful at growing my account. I'm also kind of being punished at the same time, I would feel like. But so our annual fees for a retail account, you're looking at 125 bucks for
Okay.
the account. That gets you, as I mentioned, your tax forms that you need annually to provide for your CPA. And then it's a $325 per asset fee. So an example, a house, that usually that asset fee would cover your opening and closing costs. For example, we don't
Okay.
charge per transaction fee. The only thing additionally you might see would be if you need a wire done, standard banking fees. We only charge up to 6 asset fees though. So the most you would have is 6 asset fees plus your annual fee.
Okay.
So if you have 7 houses, 10 houses, we'd still only charge you at that 6. So the
Perfect.
most you would be charged. So and if annually, if you just have the one, you're looking at 450 bucks annually for your retail account.
Excellent. Excellent. So the way I see it is that, I'm going to be opening up an account with you, and, just drop in a small percentage of each one of my deals into there. And,
Growing, yeah, growing your account.
so lending to myself, right? I could pay myself 8%. I could pay myself 10%, and just use that as a line of credit for myself.
Yeah, if you have a solo, you could take if you have a solo and you're looking to have to create to take out a loan for a personal whatever that may be, you can take up to 50,000. Of course, if you have that money, you could take up to 50,000, create your own loan back, pay yourself back, and utilize those funds in an area where you might have not been able to utilize with just your Roth or traditional. So this could be for repairs in your personal. This could be for anything personal at that point. But what's really great about it is, and our target audience is realtors, brokerages, people who are in the real estate game, because this is not a well-known strategy, but it's more so to say, hey, you're already doing this to some extent. Are you doing it in a tax advantage way? And more than likely the answer is no. So we're out there, we're educators by trade, just getting the message out there of what you can do and retire better, ultimately retire better. That's the goal.
Right. I mean, I think it's a great I think it's a great vehicle. I really wish I would have found out about this a lot sooner. I only found out about this way to invest recently over the last couple of years, and just with this conversation, it's really shed some light on, especially that solo 401, because to be able to reinvest back. And I know that this, for some of my audience, is saying, "Oh yeah, easy for you to say. I don't have 66,000 extra a year to dump into my
Hmm.
retirement."
Yeah.
But you know what? It's if you only have 10, that's better than a regular 401k,
Right.
and
And you
it's
could
you
actually
have the
do stuff
option.
with it. Yeah. We
Yeah,
just had someone needed an air conditioner unit for their house. And they have a smaller account. They created a private loan. And on the private side, you have to think that some people are able to qualify, or maybe they're for larger amounts. After you've reached a certain amount of single family homes, the bank is going to classify you differently and give you a different loan at that point. And
right.
what could that mean? A higher interest rate, or having to change it every so often, right? But on the private side, people are already used to that 8 to 12% increase. So she created a small loan for an air conditioner unit, put her created her own terms, and the guy, you could have collateral with it. That's what we would recommend. He paid her back. She made a little bit extra. So it doesn't necessarily need to be as grand as 66,000.
Yeah.
Anything, you could start really small. There's notes and tax deeds out there that
Now
are
that if I wrote a note to myself, say a $25,000 note, there would be that $350 fee as well on the note, on like private notes, or is that just for the real estate transactions?
No, that's just to hold your asset. You're actually taking a loan against yourself at that point. So it's not an asset holding fee.
Okay, so assets is like if I bought a house, I bought some.
Yeah, yeah. Anything you're actually purchasing, I should say. The loan, no, that's against that's against yourself.
Okay, all right. Awesome, Cora. Look, I think we had a great conversation here. I think there was a lot to take in. Um,
Yeah, for sure.
and I think we're gonna have you back because I probably get some questions that I want to answer, and I'd love to share the with the audience as well.
Of course,
Um,
I'd be happy to answer any questions and further assist where I can.
awesome, Cora. Well, let everybody know where they could find you.
You can find us. So we're actually located right outside of Orlando, in Longwood, 280 South Ronald Reagan Boulevard.
Okay,
You also can reach me at 407-871-9105, or our website, newviewtrust.com.
perfect. I'm gonna link that down below. Thank you so much, Cora.
Thank you
It
so
was
much. Of
great to
course.
have you, and
Yes.
I'm sure everybody's going to get a lot of value for this video.
Good,
Invest in
good.
yourself because nobody else is gonna.
Yes.
Thank you, Cora.
Right. Thank you so
Appreciate it.
much. Yes. Bye bye.